Pacific Coast Society of Orthodontists is happy to share this resource information for residents, young orthodontists, and not-so-young orthodontists as they consider their financial future. A recent survey of PCSO members showed that many members feel they would have been better prepared for a career in orthodontics had they had more business and financial education when they began to practice. This presentation is not meant to replace individual business consulting, nor is it exhaustive relative to each financial topic. Some of the information presented is the opinion of the contributor and as such contains some bias. Rather, the presentation is meant to introduce orthodontists to the financial concepts they should consider as they make business decisions that will have a lasting impact on their personal and professional fiscal state. PCSO thanks the many partners who contributed to this presentation. While PCSO does not endorse these programs, we appreciate the willingness of the consultants and companies to share information with our members in order to help them build successful practices and lives. The first part of today's program was developed by Brad Cucharo of the McGill and Hill Group. For those of you who do not know, the McGill and Hill Group LLC is a group of independently owned companies that provides a comprehensive scope of financial services for the dental profession. They offer services to help you through every step of your professional and financial career. This part of the program will provide you with personal financial strategies to help you achieve your financial goals. We'll talk about establishing a financial plan, determining your personal monthly living expenses, and setting up a budget, setting savings goals to help you reach financial independence, discuss various categories of debt, look at an example of a monthly paycheck of a recent graduate, and discuss how to select the proper health insurance for you and your family. The first step to achieving your financial goals is to actually have a written financial game plan. Not only should the plan be written, but both spouses must agree on the plan in order for it to be effective. According to a recent study, 75% of Americans that have at least $800,000 to invest do not have a financial plan. Most people cannot achieve their financial goals if they do not know what their goals are and have a plan to conquer them. The first step in creating a financial plan is to track your monthly personal living expenses, utilizing a software program that makes it efficient for you. Quicken has historically been the software of choice since it is very dynamic and easy to use. However, more recently, web-based applications such as Mint.com make it even easier for users to track their personal living expenses. Web-based applications automatically import all of your financial information and categorize your personal monthly living expenses based on the payee. As a result, each time you log into a program like Mint.com, it will update your financial information in real time. Thereafter, it will illustrate to you exactly how much money you have spent and break out each expense into its respective category. Once you know exactly how much you're spending and how much your annual pre-tax income is, the next step is to set a goal to save for your retirement. Historically, many financial planners suggested a savings goal of 15% of your pre-tax income. However, given the uncertainty in the future, many financial planners increase their recommendation to save at least 20% of your pre-tax income. Furthermore, the general rule typically applies to the average American. Since most orthodontist income is dramatically higher than the average, orthodontists should set a goal to save 30% of their pre-tax income in order to ensure they achieve financial independence. Once an orthodontist knows exactly how much they're spending, knows exactly what their pre-tax income is, and determines their retirement savings goal, they should create a monthly personal living expense budget so they can compare their actual spending amounts to budgeted amounts. Furthermore, a budget will provide a foundation to make other financial decisions in the future, such as buying a house or purchasing an automobile. As you can see on the screen, these are the general categories of expenses that you should budget for on a regular basis. Additionally, there may be other expenses not shown on the screen that you will have to factor into your monthly budget. Regardless of age and income level, everyone should review their expenses on a regular basis to ensure they do not increase too much. Often doctors' spending will increase over time without them even knowing it, which leads to financial problems in the future. Recently, there's been a lot of talk about whether you should use a debit card or use a credit card. Individuals that use debit card, cash, or check utilize the pay-as-you-go system. As a result, the individuals that use this system only spend the money that they have in their bank account. Conversely, individuals that use credit cards spend the money now and pay the bill later. Unfortunately, this often leads to an individual spending money they cannot pay back and gets them into major credit card debt. Credit card debt should be avoided at all costs since it is the number one reason individuals do not achieve their financial goals. Typically, credit card debt carries extremely high interest rates, up to 28%. One argument people make for credit cards over debit cards is that credit cards offer much better rewards programs or perks. Although that may be true, recent studies indicate individuals that use credit cards typically spend 20 to 30% more than individuals that use debit cards, cash, or check. As a result, even though a consumer will forego the rewards programs with credit cards, the substantial reduction in their spending using debit cards, cash, or check make this the preferred method. Not all debt is bad debt. There are forms of debt we consider good debt. Typically, good debt helps you generate income and increases your net worth in the long term. In other words, borrow money with the goal of making more money than you borrow. As you know, student loans are typically considered good debt simply because you are borrowing money so the orthodontic profession you join will allow you to earn a substantial amount of money. Unfortunately, we see high student loan balances as a result of orthodontic residents living the high life while in school. As a result, it should be your goal to minimize spending while in residency. Additionally, we see high student loan balances influence orthodontists' financial decision-making. In many cases, orthodontists do not look to buy practices since they have a substantial amount of student loans and do not want to take on more debt. However, obtaining a loan to purchase a practice should allow the orthodontist to pay off their student loans faster and make more money in the long run. Assuming you are buying a healthy business, practice acquisition debt is very good debt because you are using the bank's money to increase your lifetime earnings. In addition to buying a practice, purchasing the real estate the practice will operate out of will likely be your second best investment behind the practice acquisition. Even though the office building that you purchase normally is a large investment, some orthodontists get themselves into trouble by spending too much on the office facility. Finally, the last type of debt that we consider good debt is home mortgage debt. That said, it is very critical that every aspect of your financial life is reviewed before you make the decision to purchase a house. Many people buy more house than they can afford, which ultimately destroys their financial game plan. There is no one-size-fits-all formula on how much you spend on a house. Rather, as mentioned earlier, it should be based on your individual personal financial situation and cash flow. Other than the type of debt mentioned on the previous slide, most types of debts are bad debt. A debt is considered a bad debt if it is incurred to purchase depreciating assets. In other words, if the item you purchase will decline in value, the debt is a bad debt. Most of the time, items purchased on credit cards will decline in value. As a result, almost all credit card debt is considered bad debt. Additionally, most automobiles depreciate over time. Therefore, although many people consider an automobile a necessity, purchasing an automobile is not a good investment. Furthermore, airplanes, boats, furniture, and electronics normally depreciate over time, are very expensive, and are not a good investment. Finally, although the fair market value of a vacation home could go up over time, the debt associated with the vacation home combined with the operating expenses do not make them good investments. Orthodontists that avoid these types of debts normally end up much better off financially compared to the orthodontists who incur these type of debts. This next slide illustrates 3 common mistakes orthodontists make when they graduate from residency. Many orthodontists buy a big house, buy a nice new car, and purchase nice furniture, artwork, and electronics on credit to furnish their new house. As a result, these orthodontists acquire significant debt early, which will make it very challenging for them to achieve their financial goals in the long term. When it comes to purchasing a vehicle is almost always more cost-effective than leasing a vehicle. Additionally, the most economical way to purchase a vehicle is to buy one that is 2 to 3 years old with 20 to 30,000 miles. Normally, the cost of this vehicle will be 30 to 35% less than purchasing a new vehicle. Additionally, the slightly used vehicle often still carries the manufacturer's warranty for a short period. Finally, the longer an orthodontist drives their car, the more economical it is. The longer the car is owned, the lower the cost per year, since the car depreciates much faster in the initial years of its life compared to the later years in the vehicle's life. It is easy to overspend on housing in a very short period of time. When orthodontists are in residency, the less spent on housing, the better. Orthodontists can minimize their housing costs by living in smaller apartments and having multiple roommates. Upon graduation, in many cases, it is preferred to rent for a short time. Renting provides the most flexibility, provides the orthodontist time to make a good purchase decision, and will help minimize the risk of the orthodontist overspending on a house. Over the past 10 to 15 years, the amount of student loans orthodontists graduate with has increased substantially. As a result, many orthodontists can't afford their student loan payments once they graduate and are working as associates. Before any financial decision is made after graduation, it is extremely important to understand how the student loan debt service payments will impact your personal cash flow. This is a chart that illustrates different loan amounts paid back over 30 years at an interest rate of 6.80%. As you can see, the monthly payments are substantial and will dramatically reduce the amount of personal cash flow an orthodontist has after residency. When orthodontists graduate from residency, many of them establish a goal of repaying their student loans as soon as possible. Although this is a great goal, it is not the most efficient way to utilize their income. Many orthodontists forego saving money for retirement on a tax-deductible basis. As a result, they overpay their taxes and utilize after-tax income to pay down their student loans. The best approach is to maximize all tax-deductible or tax-deferred savings vehicles. Once the tax-favored vehicles are fully utilized, then the orthodontist may use additional income to accelerate their student loan payments. The section of the program after this deals with that consolidation and refinancing student loans. However, before student loans are refinanced, orthodontists should consider utilizing the governmental income-based repayment program, or IBR, that minimizes monthly payments. However, if an orthodontist does not qualify for the IBR program or they have sufficient cash flow and they do not want to utilize it, they should give strong consideration to consolidating and refinancing their loans in order to dramatically reduce interest costs. Whichever direction the orthodontist goes, the decision should be made based on their individual circumstances, personal income, and most importantly, their cash flow. This next slide illustrates what every orthodontist should do upon graduation and accepting their first job. Every orthodontist should project their gross income. In this example, the orthodontist's income for the year will be $180,000. The orthodontist elects to make the maximum 401k salary deferral of $18,000, will pay federal income taxes of $26,686, state income taxes of $9,049, and payroll taxes of $9,957. As a result, their net after-tax income will be $116,308, which equates to $9,692 per month. Assuming the doctor will want to save $1,500 per month for retirement or a house and will pay $2,192 per month in student loan payments, their after-tax income available for personal expenses will only yield $6,000 per month. Thereafter, the doctor should take their $6,000 per month for personal expenses and complete their monthly living expense budget. As you can see, we reviewed this chart earlier. However, it is important the monthly budget does not exceed the amount available for after-tax living expenses. Under the new Affordable Care Act rules, every American is required by law to have health insurance. Your goal is to minimize your health insurance premiums while minimizing expected out-of-pocket medical costs. When selecting a health insurance plan, the first step is to determine how much the health insurance premiums will cost. The next step, which is very challenging, is to estimate the expected out-of-pocket medical expenses. Once you have both numbers, you should combine them to determine the total projected cost. Then you may compare your different health insurance options and pick the one with the lowest projected cost. Normally, high-deductible health plans have the lowest health insurance premiums. Since most orthodontists are young and healthy and will have very little out-of-pocket medical expenditures, a high-deductible health plan will be the policy of choice. Additionally, the high-deductible plan will qualify the orthodontist for a health savings account, which can have long-term tax and security advantages. If an orthodontist qualifies for a health savings account due to having a high-deductible health plan, they can fund a health savings account on a pre-tax basis. The The maximum tax-deductible contribution is $3,350 for an individual policy and $6,750 for a family policy. All money is contributed to the health savings account on a tax-deductible basis, and the money grows tax-free each year if it is not used. The money in the health savings account is not required to be used each year, so an orthodontist can let it accumulate over time. For the last part of this section, we will share the top mistakes we see orthodontists make. For most people, if they are able to avoid these mistakes, their finances should be in good order long term. The first mistake we see orthodontists make is not having a financial game plan. Without goals and a plan, it is nearly impossible to reach financial independence. The second major mistake is not having a budget or spending plan. Not having a budget or spending plan is like trying to place braces without an x-ray. Other common mistakes are using debt to buy depreciating assets, not saving enough for retirement, and delaying retirement savings to the future. The final mistake we see is orthodontists consistently buying things they do not need to try to keep up with the Joneses.